Since 1947, the Indian government they realized the importance of industrializations and the needs for industrial concerns, the money that can fund that can solve the industrial concerns. So they realized they need someone who were able to provide long-term and short-term loans to solve the industrial concern. And at this time, IFCI just taking the gaps at a gap filler to provide long-term and short-term funds that will solve the country's industrial needs by providing low-cost funds. However, this lion for years has taken advantage of such policies set by the governments to yield the advantage. But it seems that the momentum has stopped ever since the government has took away the shield it granted to this lion. And for years it has remained hibernated, wounded, and just waiting to strike for the next opportunity. And ladies and gentlemen, good afternoon. We are a team from CityU, and today we're bringing you our solutions on how to help this lion to regain its glory in the banking industry and compete in the market. May I first walk through the agenda? We'll basically go through the background of the case and an evaluation of the turnaround strategy that it has considered. And finally, we'll come with a set of recommendations on how it can develop a future business. So, a little bit on the background. What is happening to this bank, to this institution? It was how, as I've mentioned in introductions, this institution was only in existence because the government realized the needs for long-term and mid-term loans to support industrializations. So when the government essentially gives the institution a shield to provide low-cost fund, and such a competitive advantage has been relied on ever since the institutions was founded. So essentially, it shielded the institution from other competitors. So it's kind of monopoly in such market. However, in 1991, the Indian government, they changed the policy. They started to guarantee bond quota. They withdrew institutions' tax-free status. Essentially, the line between financial institutions and commercial banks are becoming blurred. So, in a nutshell, IFCI does not have a shield anymore. Right now, what they have to do, they have to go out the free market and compete in the jungle. But the question is, it seems that after years of babysitting by the governments, the institutions seems to be unable to compete in the free market. So here comes our key questions. How do we help him to compete in the free market? So it has, given that it has changed from statutory body to a company, it faced two problems: increasing competitions and its ability to meet with the increasing business needs. But if you take a closer look, its current business portfolio comprise mainly traditional commodity sectors. And you may call it bad luck. In 1997, it so happened that Southeast Asia financial crisis hit India. So every traditional commodity sectors was seriously affected and resulted in IFCI almost collapse because it cannot collect its funds, its loans from the sectors. So what happened next is that it has to consider various options so that the company can survive, can still in the business, can still the profit. But then it has come through a lot of options. Number one being liquidations. But is liquidation an option? No. Why not? First, as stated in the case, liquidation sends a wrong signal to market. As a fully supported institutions before, IFCI stands in the market as a market leader. If it liquidate, it will trigger a cascading effect on financial institutions. They will fear that the government no longer supports, and there will be a dramatic change happening. They will simply fear to continue their business. And another drawbacks of liquidations is that it took years. It took years to complete and yield results, and that would not solve IFCI's short-term problem. And thirdly, the government have to rehabilitate employees because they were basically unemployed. How government can make sure the transitions of these employees happen? is another key difficult task to be answered. Last but not least, there will be political compulsions between different parties in India. Given all these concerns, it all comes to the final conclusion that shutting down is not an option. So, what other options has the institution considered? Alva, would you like to talk more?
Thank you, Sky. And this part we're going to show. How about merging? We will see it in the general sense. First, we will going still have a synergy effect if we do merging, and then we will stay in the business in terms of economic of scale, stronger bargaining power, and the market shares. And however, it will, according to the McKinsey report, 70% of the merging failed because the dilemma of determining the price overvalued, and it's hard to cooperate to businesses. And this is the general sense of how to do the merging. But how about the cases? The PNB and IFCI do have some positive impact towards its merging, because its retail banking sectors and project financing create a diversified and universal bank synergy effect here. And it also crossed the win-win situation, because IFCI played a role of its investing banking arm of PNB. So it seems it has a very strong synergy effect here as well. However, the capital adequacy ratios and the valuation ratio are not favorable for merger to do the merging. And PNB investors are not favored in merging with the IFCI. So, and PNB, the merging case is not favorable in merging. How about in our case? IDBI and merging with IFCI do have some positive impact. For example, like a greater operation flexibility when compared with the PNB merging case. And the same point is the similar work of IFCI and IDBI. The work culture and their salary or even the compensation structure are similar. So these two merging have a similar work, so it has a positive impact here. And how about the negative part? The financial cost has essentially increased because, as Sky mentioned before, the government do not support IFCI because they used to get a cheap finance from no rate from the government, but government don't support it anymore. They will raise the money from the market. It do have a negative impact here, so they will see this as no future in the coming emerging market. So the negative impact is higher than those positive impact here. And this, we were going to wrap up it in the free pyramid later on, and Maggie will going to show you another method, strategic partnership. Thank you, Maggie.
And an option for IFCI is that they can have a strategic partnership, which means they can sell like 24% of the stake to other people, either single or a group. We have evaluated this option, and then we have found two advantages and two disadvantages. The first advantage is that it's a time-saving transaction, because you just have to deal with the price and also the receipt number in the board, rather than to have a strategic decision whether to go into this business. Just for example, like merging, you have to decide which business to go and then which market to go. And then another advantage is to monitoring the efficiency, because you have a new board members because they buy the stake, and then they can get the board seats, and then they can help to monitor the efficiency. However, we find there are two disadvantages as well. The first one is this is not an option for curing the real problems, because it has a difficult financial situation like many NPAs, this non-performing assets. So that if you just have the strategic partnership, it's hard to get a real like a restructuring plan or any strategic plan out of this strategic partnership. And then another disadvantage is hard to find a strategic partners. It's very costly to hire an agency to find a strategic partner for you. In this case, the company has hired Ernst & Young to find a partner. However, because of its poor financial situation, they couldn't find a partner to do this strategic partnership. And then we have another option. It's the restructuring. Restructuring, we also find their advantage and disadvantage, and we compare them. The first advantage is that curing from the risk of the problem. Because of restructuring, we have carried out a detailed plan about how to make it financial restructuring and as well as the operational restructuring. For example, financial one, they can deal with the loans and then the non-performing assets. And for the operational one, they can deal with the morale by improving the appraisal system and so on. And another one is that retaining the full control, because they don't have to sell the stake and they don't have to merge with another like company, so that they can get the control as usual. They don't have a change in the ownership. And then, however, there are also disadvantages. The first one is the negative organization impacts, because they have restructuring in both financial and organization aspects. They have to make huge changes. For example, they have to cut down the staff, like 50 staff from 2014 to 2004 to 2006, sorry. And then they also adopt the IT like structure and system, so that the people get time to adapt to it, and then they have to train for it. And then it's very time consuming, because they have to develop the plan and then to actualize the plan and then to implement the plan to get the effective results. It takes time to reflect the result, as well as mentioned in the above, they have to make the changes in the staff and the organization structure, as well as to adoption of the IT system. So it takes time for the staff to adapt to the new changes. And then I will let Angel to talk about the detailed restructuring plan of IC.
Thank you, Maggie. So as we can see, the financial restructuring will be separated into three parts. The first is to lower the cost of borrowing. As mentioned by my teammates before, one significant challenge that IFICs encounter is that they are no longer have access to low cost funds. To restructure the company, the first thing to do is to lower the cost of borrowing. And to lower the cost of borrowing, it will be separated into two parts. The first is to gain access to special government securities at a GSEC rate. It's actually substantially lower than the market rate. It's around 0 to 6% from the government. And secondly is to secure the debt support from the two banks, IDBI and State Bank of India. Since they are all public sector banks, that they are willing to help the company to survive in terms of public sector. And secondly is debt restructuring. As mentioned by my teammates before, the company is suffering from a lot of non-performing loans, and its debt to equity ratio is extremely high, and the company suffered from a liquidity problem. So to help save the company, we have to extend the maturity of the loans by public sector banks, and also there is a launch of the zero coupon optional convertible debentures. Since it has the equity, has the option to convert the debentures into equity, more investors are willing to purchase this type of financial instruments from us. And the final step is the privatization of ownership. Actually, as we can see, after the restructuring, the shareholdings of the banks plus financial institutions and public has dropped significantly from 72% in 2004 to 47%. So after we have transformed the company from a public sector financial institutions to a private sector company, it will enjoy the features and to step into the jungles to compete with other financial institutions. And here is our summary of all the options. We evaluated the options into these aspects, the length of the process and the degree of control our company can have, and their impact on the financial parts and the implementation costs of different options, as well as the organizational improvements. And as we can see that from this evaluation, restructuring is actually the best option among all the alternatives. And next, so after we did the restructuring, the major issue is that how can we survive in the future? As we mentioned before, the lion has already lost its glory in the past. apart from clean up our balance sheets, eliminate the non-performing loans, and trying to secure new cash support from the government, from other banks, the most important issue for us is to have a sustainable business plan in the future. So what we are going to do is our 2E strategy. The first E is empower the organization, and the second is embrace the market trend. And then we will elaborate them in details. So for embrace the market trend, we have analyzed the market trend of financial institutions in India and what our core competencies as IFC. So as a domestic financial institutions, we do have competitive advantage over other foreign banks. Actually, our group happened to read industry reports about the financial institutions in India. It said that there is a growing restrictions on government policies on the capital flows and the transactions that can be conducted by foreign banks such as Standard Chartered and Citibank. So the government are showing favorable policies towards domestic banks. That's the opportunities that we can grasp. Secondly, our bank has a better understanding of the local customers. Actually, in the religion of India, they consider borrowing money as a kind of disgrace. Actually, many Indian people have the tendency to borrow from domestic banks because they found they are more religiously appropriate to do so, and they have multiple product portfolios for them to choose from. And secondly, there is a emerging trend in the IT outsourcing business of multinationals in India, like IBM and big merchandisers are trying to launch their IT business divisions in India. So we want to grasp these opportunities as well. We want to provide trade accounts clearing services and like rupee exchange hedging for those multinational companies who have their IT infrastructure and conduct their trading houses in India. And thirdly, we want to diversify our product portfolio. Rather than only providing short-term and long-term loans to corporations, we want to provide asset management services, like since the rising middle class in India and the people there have higher dispensable income, they may have the demand for financial instruments for the higher income families to manage their family wealth. And fourthly, we want to provide small, medium-sized enterprises financing channels. Especially in the rural community of India, there is a growing number of small, medium-sized enterprises starting. So we think that we can provide short-term liquidity to these kind of startups for them to develop and to earn like higher rate of return. And after that, Sky will talk about how we can empower the organization.
So thank you, Angel. So how do we empower the organizations? 4 things. 1, a good appraisal systems as suggested by the case, and we will further elaborate the suggestions in the case to an extent that we'll introduce a balanced scorecard concept in the organizations, which emphasize on whole person development of the employees. And second, specialized training. Further to introduction of a balanced scorecard, we see that 63% clerical staff are without updated knowledge. What do we do? Update their knowledge. Third, strategic business units. What does it do? It's trying to expand our different business into asset management, small, medium-sized enterprises nodes, and last but not least, we should maintain a good relationship with the unions. We don't want some internal problems with the unions when we're phasing out competitors in the free market, right? No. So, in conclusion, to wrap up our presentations, how do we help the client to compete in the market? How do we make sure it yields clause in trying to take shares in the market? Through our 2E approach. Number 1E, empower the organizations. And by empowering the organizations, we're trying to embrace the market trend to seize new business opportunities through our various suggestions. That's the end of the presentation. Thank you very much.
Thank you, students from the City University of Hong Kong. There's now 15 minutes of time for a Q&A between the judges and the students.
think it is very impressive because with a case such a complicated one, and you guys can really come up with a presentation like this and a
Thank you.
level, I think it's good.
Thank you.
I have one question first. Given the brand of this institute is long in the market, when they get through these kind of options of how to really rejuvenate, how to survive, they choose to restructure. And also, they restructure one of the significant way is cut down a lot of people. In which, what exactly, how an organization with such a big monster and become restructure into today's, like what you suggested, and eventually how it come into. What is the major things that as a CEO or the management they see to get through this kind of process of downsizing, trimming a lot of people, and manage the overall? Because one of the key things, remember, in the case saying that they really respect the kind of the staff, the unions, and all that. So it is internal morale about it is a big issue. So the CEO, how you think that this should be the way to not just carry on with this restructuring, but carry onwards to manage the company?
Let me take the questions. So as we have mentioned in our recommendations, there will be an appraisal system which will include a balanced scorecards concept, and these, as well as our approach to maintaining good relations with the unions, and the details of which, due to time limit, we were not able to fully explain. So let me take a chance here to further elaborate about our fourth point, which you have addressed, the union relations. So how do we maintain good relations with the union? As a usual practice of the institutions, it involved the union leader in major decisions making. And because of this good practice, there has only been one strike in the history of the institutions. So our recommendations is, of course, keep this good traditions. Why vault good traditions when it's doing well, right? So in other recommendations we are trying to further elaborate is that they can try to build a better relations by engaging the union community more through different ways. First, maybe more festive celebrations with the union, or more sponsored for unions relations, unions community building, like sponsor the kids, scholarship for the kids, and our medical compensations in case of injuries. But even though that it's very unlikely for you to get injured in the financial industry, but then we still can try to negotiate with them. So regarding the long-term development within the company in terms of staff morale, we believe that through our two recommendations, it will help to boost up the already high staff morale, because the company has downsized a little bit, right? The staff morale may be a little bit low at the moment, but since the whole company in general is making money again, so the staff is seeing a promising future coming. They feel that whatever they're doing, they're actually helping the company grow. They're helping the company to regain its glory. So with staff feeling this sense of commitment to the company, the value of their work, I believe that further to this status quo, these suggestions will further push them forward to make the momentum grow. Yes.
Sure. Well, thank you very much for the presentation.
Thank you.
I have two questions. The first is that when you comment on the restructuring as an option, I think one point you made is that the impact, organizational impact, is negative. I guess given, my question is, given the background, where the organization come from, and what happened to the organization, why do you think the impact is negative? Number one. Number two, I think that from a forward-looking perspective, you recommended the institution expand its business scope into asset management, as well as to serve SMEs, the small medium enterprises. Based upon your understanding of this particular institution, what do you think are the competitive advantages of this institution in serving SMEs? So from a typical strategic perspective, why do you think that's a viable option from a forward-looking perspective? So those are two questions.
Okay, let me answer the first question. Actually, we are not saying that reorganization has a negative impact on the organization as a whole. We are saying that it has some negative effect on the morale, and there is lots of layoffs of employees. So there may incur some negative impact. But overall, we think restructuring is like the positive impact will outweigh the negative part, because it helps to clean up our balance sheets, lower the non-performing loans, improve our debt-to-equity ratio. All this from financial perspective, it really helps our liquidity and profitability in the future. And concerning about the negative impact of employees layoff, all these things, we are trying to have some compensation, and we are introduce all these programs to better manage the relationships. So we think this kind of negative impact can be reduced to a large extent as well. So overall, the positive outweigh the negative. Yeah. And for the second question, like why our company has competitive advantages to provide SME financing, is that first and foremost, as mentioned in our analysis, domestic Indian financial institutions has a edge when competing with foreign banks like Standard Chartered or Citi, because the financial regulators are showing favorable attitudes towards domestic. They want to protect domestic banks. So that's the first reason. The second reason is that since this company has a long history of providing low-cost fundings, is a kind of a gap filler. It's not a big player in the market like those larger, like we mentioned, the PNB and the IDIB. They are really larger banks that have a variety of business segments. We only focusing on filling the gap between the big corporations. So we provide short-term funds to the relatively lower standard of borrowers. So I think that's another reason, because we have kind of entered this market earlier, but we are not focusing on small medium enterprises, but we have the history of dealing with those relatively low credibility or not well established companies. So we may have that kind of expertise for startups as well. And thirdly, as mentioned, since the emergence of the IT outsourcing in India, we think that there are more IT startups in India in the current market. So for IT company, actually, they do not have that heavy balance sheet to invest a lot of money in PPEs. So the startups the capital requirements for IT companies are relatively lower than those, real property or something like that. So we think that SME is a profitable business for us to deal with. Thank you.
Okay, a couple of questions from me. First one is a bit more out of the box. Okay, other than the options that your team has considered and articulated here, have you thought about other possible alternatives?
You mean to improve the
Yeah, we talked about liquidation is not possible, okay, and mergers with some of the other institutions, restructurings, etc., etc. How about, other than those options that you have discussed, have your team actually thought about other possibilities as well?
Yes, but the other possibilities are really like a little bit tedious compared to these large methods. So we have thought about like try to raise more funds from the equity markets, but we don't think it's feasible because the company itself is dying. So the equity market won't buy our additional shares, and it will dilute our ownership as well. And secondly, we want to issue like convertible bonds. It actually is a part of the restructuring scheme, but this type of convertible bonds is zero coupon convertible bonds offered to the public sector banks. But we are thinking about how about issue the convertible bonds to like the general public with an option to exchange their bonds, debentures to equity. But we don't think that the general investors in India would have that expertise towards convertible bonds, because the major dealers in Indian market is still like the big financial institutions. And we also think about how about we try to like write off the non-performing assets, but it actually because we suffered a lot from the general commodity market, the sugars, as Sky mentioned before, because of the economic downturn. Maybe like after the general commodity market pick up, our non-performing loans may recover in the near future, but there's still a lot of uncertainty here. So all these methods is kind of abandoned.
Okay, thank you. Another quick question. Assuming that the restructuring is the best options that you all agree to pursue, and I think you agree that there are many factors that can contribute to a successful turnaround. How about the downside? Okay, what can go wrong if the restructuring doesn't work out as you want to? What are the risk factors?
Okay, let me take this question. For restructuring, because it really has to go through a lot of procedures. For example, you got to secure the source of financing, and you have to negotiate with the creditors to extend the maturity of the debts. One risk is that the creditors are not willing to extend the majority any longer, because give the company more time to repay the loans. They still doesn't have the ability to repay. Then they won't like to extend the majority. However, we think that creditors are willing to take our offer to extend the maturity, because like what if our company just go out of business, like we went to bankruptcy or liquidation, then what the creditors can gain is actually much less than like we continue our operations, because for liquidations there is a lot of legal expenses to pay to the liquidators, to the courts, to divide the residual values of the company. So the creditors would tend to accept our offer to extend the maturity. And the second risk is that after we have done all of this to improve our liquidity and profitability, what if we don't have the sustainable business plan that like as long as we have improved our balance sheet, we don't have the sustainability to generate a new income or to improve the operation of the business in the future. So like even though we have eliminate the non-performing assets or improve the debt to equity ratio, we may still face the same problem in the future.
And financial aspect aside, in terms of organization management, as we have mentioned in our suggestions, maintain good relations with the units itself is a contingency plan against possible internal conflicts. Say, let me give you a hypothetical situations. What if, when we are pushing the restructuring financially, the employees, they feel this grievance of not feeling to do it? They just have, no matter how we appraise them, they just don't accept it. Who can approach them? The union. The union neither, because they belong to another community, and we regularly meet up with the leader of that community. So in this sense, our fourth suggestions under empowering your organizations itself is a contingency plan against possible risk of strikes and internal conflicts. Thank you.
All right, this concludes the Q&A session of the presentation by the students of the City University of Hong Kong. Let's give them a round of applause.
Thank you again.